I'll just pause, but I want to sort of maybe tell a story just before we start formally. It was really interesting last week at budget time in the House of Commons, and what is always tradition is there's Prime Minister's question time before the Chancellor hands down her budget. And so it is one of the biggest days of the year in Parliament. And it was really interesting for Australians, particularly, to hear the House, the Speaker for the House of Commons, just before he handed over the Prime Minister, say he wanted to thank the Australian High Commissioner, Stephen Smith, for his 3-year tenure as the High Commissioner, which ends actually at the end of this year. So it's a really nice shout out, good recognition of Australia, good recognition of the partnership that's been built up under his guise over the last few years. And after he handed off to the Prime Minister, Keir Starmer stood up and also turned around to the gallery and thanked our High Commissioner, Stephen Smith, for the work and important contribution he'd made between Australia and UK. So for us, I have to say, those people in Australia House, a really significant moment. And I know Stephen Smith was particularly proud of that. So it was a nice touch just before the Chancellor handed down her budget, which, I don't know, I'm trying to look for the right word with that budget. We're independent, we're not government, so we can sometimes say things and not too worried about, but it wasn't so exciting. And maybe that's a good thing. But, I was going to use the word bland, but maybe that's not the right word. But anyway, we'll get underway. Here we go. Introduction. I've been talking and haven't introduced myself. Richard Basil-Jones. I'm the CEO for the Chamber, Australia UK Chamber of Commerce here. We are based within Australia House. We work alongside Austrade, the High Commission, and the State Trade and Investment Groups. We are a not-for-profit group, and as I mentioned, we are independent. It was interesting looking through the very long list of registrations for today's webinar. There is a lot of individuals that have registered who are from companies and organisations that we're not familiar with and are new. And that's a great thing, by the way. What the Chamber's remit is, if you like, is supporting, informing and connecting people and organisations with interests in both Australia and the UK. And so for those people that are new to us, please make sure you reach out and connect with us and contact us. We'd love to see you at future events, and we'd love to see you become Chamber members. So that's my advertisement right up front. We'll start getting underway now in the serious part of this webinar. The webinar has been titled UK Autumn Budget 2025, and that is an important part of this webinar, but it really wasn't going to be the focus. We deliberately left time, and under Menzies' guidance, said, you know what, I think we're better to wait a little bit and dig deeper into the weeds, particularly if there's any announcements around the tax implications for Australians. But let's not just do what happened last night with the budget or yesterday with the budget. Most companies and most people have connections into those sort of webinars, but we wanted to just do something a little bit different, wait a little bit of time, see if there was anything really in there for tax implications for Australians in particular, and then go from there. As it turned out, despite 50 different leaks and thoughts around different taxes that might occur before the budget was actually formally announced, a number of the items that were sort of referenced, be it exit taxes or national insurance on rental income for people with properties in Australia, and all sorts of things that were mentioned didn't come to pass, that didn't happen. But there are still significant implications for Australians who are here in the United Kingdom. And what we know, and we know because we're interacting with people day in, day out, is that this issue is significant. It's very important and it's significant. And it was significant from the last budget in April, where, if you like, the non-dom regime was scrapped. My terms, not our business consultancy and tax advisors from Menzies terms. These are my terms, layman's terms. But the implications for the wrapping up of global assets after 4 years of residency in the UK, the implications on inheritance tax and other sort of changes to the taxation system for us are real, and they're very important. And you need to get your head around it. It is so important. They have significant implications. So on that note, I will be quiet. Housekeeping, this webinar will be recorded. There's a Q&A function at the top that you can use and ask questions, and we'll get to those at the end of the webinar. The webinar's due to run for about 60 minutes. We will record it. We will send a link to everyone with the recording in the next 24 hours, again, for you to view and review. And it will also have the contact details of our experts from Menzies, from the Menzies organisation, which are a business advisory and accountancy firm who are great chamber members of ours who support us regularly. We have 3 guest speakers, Martin Hamilton, Helen, Cuthbert and Anish Chawla. We're going to hear from them and you're going to hear very little from me. That is the perfect setup for the webinar. On that note, I'm going to hand over to Martin.
Thank you very much, Richard. A pleasure to be here and working with the Chamber once again. Thank you for having us. And a thank you to Nicole and Vera and everyone at the Chamber behind the scenes who've helped put this webinar together. Welcome to all the viewers and thanks for joining from the UK and Australia. I hope you find this useful. As Richard mentioned, I have Helen Cuthbert with me, who's a partner at Menzies in our private client team, and Anish Chawla, who's a manager in our private client team, and they'll be doing most of the talking today. As Richard mentioned at the top, it was arguably a bland budget. There wasn't any major changes to the headline rates of taxes. However, there were some small, significant but small changes, which I will be running through myself, but we're not going to get into the nuts and bolts of the budget today, really. There wasn't a huge deal there for us to get our teeth stuck into, especially from an international perspective. Yesterday, Menzies did our own budget webinar where we do get into chapter and verse of everything that was mentioned, and we will try and send that link out with the thank you email afterwards, and if our video is ready, and if it's not, we'll send the link to our website where you'll be able to find it afterwards if you'd like to know a little bit more about the budget in a bit more detail. But as Richard mentioned, we're going to focus today on the cross-border issues previously announced, non-dom bits and pieces. Before this webinar, we did have some questions come in, and most of them were really focused on the cross-border issues. So I think that's a really good topic to spend some time on to provide some clarity. There is some confusion amongst the residents of the UK, especially international residents, about how it impacts them. And so we've got Anisha and Helen to run through those bits in a bit more details. But I will be starting off with the first slide, which is really going to be covering the minor but major announcements in the budget that we just had. Now, as you see from the slide here, it says, do we have a £26 billion tax grab, or is it far more than that? Well, the £26 billion tax grab effectively only goes up to 2029. And if you look at the 5-year period to 2031, it's a lot more. And you'll be able to see that with the numbers below. So I'm quickly going to run through these, but not in huge amounts of detail. Again, if you want some more detail, you can contact us afterwards. You can review our budget report on our website, or wait for our budget webinar to be uploaded to that website further down the line. But looking at fiscal drag at the beginning, as you can see, fiscal drag is by far the most effective method, expecting to generate £23.5 billion in tax. This is a stealth tax rather than something immediately noticeable in pay packets. Ultimately, it is a way a government can increase tax without increasing tax rates. They do this by freezing thresholds, and our personal allowance threshold has remained at just over £12,500 a year, and our high rate tax threshold has remained at just over £50,000 a year. Now, if those personal allowance and high rate tax thresholds had increased in line with inflation, they'll currently be sitting at £14,400, and £65,000. So you can see that over the time that these thresholds have been frozen, lots of people have been dragged into higher rates or basic rates of tax, which is how the 23.5 billion and the money historically before has been raised. The government is relying effectively on psychological benefit of there being no negative pay impact, but this does really impact and squeeze income for all taxpayers in the UK. The second element on this list here is the dividends. A 2% increase in the dividend rates from April 2026 has been announced for basic rate and higher rate taxpayers, but not for the additional rate taxpayers. So ultimately, SMEs and entrepreneurs should really consider whether to accelerate their dividends before April 26 to ensure that their full basic or higher rate allowances are being used. The reason the additional rate taxpayers didn't see their rates increase is because it would really diminish their earnings when combined with the effective tax rate from corporation tax, which would lead to them paying tax of over 55% if they took all their profits as dividends, and that's a big bitter pill to swallow if you're paying tax of over 55%. So the additional rate payers didn't get their rates increased, but everybody else did. If you're looking to save, you've been impacted as well in this budget. There's been a 2% increase in the savings rates. So this is a kind of a message to make sure you're saving in the most tax efficient way possible. If you're looking at ISAs or other ways to save money, which can be tax free, then you should be really focusing on that. But ISAs have limits. Those limits have been reduced in some regard in this budget. Therefore, if you do have savings with interest with savings and interest accounts, then there will potentially be a 2% increase on the tax you pay on them. Additionally, salary sacrifice has been well documented before and during and after this budget. From April 29, salary sacrifice on pension contributions will be restricted to £2,000 per person. Whilst this doesn't impact individuals' tax rates, it certainly impacts individuals' NI contributions as well as company NI contributions, and it's going to raise a significant amount of tax, as highlighted here, 7.4 billion. And the final point, really, the final major announcement was the mansion tax coming in from April 28, which is impacting properties from £2 million up to £5 million, with additional taxes of £2,000 up to £7,500. So, as I say, that's a short kind of run through about the headlines on the budget. Again, if you want the nuts and bolts, you can find that on our website, on our additional webinar that we did yesterday. But I think Helen will provide a few more headlines now with a more tax-centric focus before we then really focus on the cross-border element, and at the end we can then answer any questions you have. So Helen, over to you.
Thank you, Martin, and good morning, everybody. So we've had two really quite significant tax raising budgets in a row under Labour, and it's somewhat focused minds in the UK, not just on what has changed, but also on what was anticipated or trailed, which perhaps didn't fit the bill this time. So a number of opportunities to focus on. Yes, we've got fiscal drag, which is going to pull in a significant amount of tax over the coming years. And actually, that fiscal drag continues beyond the realm of the current Parliament, which will come to an end. We have to have a general election by the middle of August 2029, and we currently have rates and allowances that run up to 2031. So some were anticipating a reduction in the thresholds for income tax. We have a threshold right at the top for additional rate taxpayers of just over 125,000. That has stuck, but some were anticipating that that would drop down to maybe 100k or even 75 for the additional tax rate. NIC reform. Many have called for wide-scale reform. So NIC is National Insurance Contributions. It's our social security. And it was anticipated that at some point a government would take things by the and grab the opportunity to pull NIC and income tax together. And we thought at times before the budget that that may be the direction of travel. That hasn't happened. Pensions. So we have had significant changes with salary sacrifice that's going to come in not for a while yet, but until 2029. But there had been concern that there would be a cap on the tax relief given going into the pension and a reduction in the tax-free cash coming out. You might have heard that there was a lot of focus on that before the budget, and a lot of people pulled out their tax-free cash ahead of the budget in case that amount went down, which has been somewhat damaging. VAT expansion, so a reduction in the threshold to pull more businesses within the realm of VAT. That hasn't happened. It may, of course, happen in the future. Capital gains tax is probably the part that surprised me the most, that there wasn't an expansion of the capital gains tax grab this time round. We were anticipating perhaps a rise in the rate or a limitation on a really important capital gains tax exemption that takes place where an asset moves from one person to another as a result of death. So there is a washout of the capital gain that has accrued over time at the point that an asset switches hands on probate. Of course, in the UK, there's an inheritance tax charge at that point in time. And so that's why historically we've always had a CGT exemption. People were considering and wondering whether that exemption was going to go away. Extensive changes to IHT, so inheritance tax and lifetime gifting. Many people in the UK give away assets where they can during their lifetime so that their estate is not as big and swollen at death as it might otherwise be. And there was concern that there would be some kind of lifetime cap on gifting, or that there would be a longer period for which gifts can be taken into account when someone dies. At present, that is a 7-year period, and there was concern that that was going to go to maybe 10 years. That has not happened. So what we do have is a renewed interest in making some really good wealth and succession planning and inheritance tax changes. Exit tax, definitely key to the people in our audience today. The damage was perhaps done pre-budget. There's no exit tax as it stands when somebody leaves the UK, other than a small tweak to profit extracted for owner-managed businesses where an individual moves overseas temporarily. Next slide, please. So Martin's already alluded to some changes in rates for those various taxpayers who have particular types of income. So property income, the tax rate on property income will increase from 2027 by 2% on each and every band. So we're talking about those who are landlords in the UK. So what should they do? Briefly, they should think about how they can manage their costs. If management in full isn't possible, then think about how that they can pass those costs on where possible. So I think we're probably looking at a period of rent review into the future. Some individuals will think about incorporating their property business. Perhaps they own those properties in their personal name at present, and they think about putting them into a company. What I want to just touch on today is there are a couple of really key tax issues if you decide to incorporate a property business, and they are stamp duty land tax, or SDLT, and capital gains tax, or CGT. Capital gains tax will be charged on the uplift in the value of that property throughout the period of personal ownership. We'll also need to have people thinking about how they're going to fund that property once it's in the corporate, because there might need to be some rejigging of the mortgage, because the mortgage now needs to be in the hands of the corporate. Savings income, so that's income tax on savings income from bank accounts and the like. The tax rates on savings income are each going to go up by 2% again from April 2027. So very briefly, what do people need to think about before that time to manage those charges in the UK? Think about what they can invest in an ISA. Now, the ISA investment limits are going to change from the same period, but for those under 65. And the change that's going to be made is to try and encourage, whether it actually does this is another matter, but to try and encourage people to save into a stocks and shares ISA rather than a cash ISA. So the cash ISA limit that can be put in each year will drop from 20k to 12k from that point in time. A very simple thing that can be done to protect against savings income charges are to invest in tax-friendly wrappers. So ISAs, as I mentioned, bonds on which you can control the income yield, or premium bonds. Use your spouse's ISA allowance where possible, and if applicable, their lower rates of tax. Next slide, please. So the mansion tax. The mansion tax, I think, had been talked about an awful lot in the UK before the budget. And in some ways, it is disappointing that it's come in, but in others, it perhaps isn't quite as far-reaching as we thought it might be at one point in time. So what is it? It's actually a council tax surcharge, and it will apply to properties that are valued at 2 million or above. So there will be a whole revaluation process that takes place in 2026, ready for the new charge to take effect from April 2028-29. The valuation is going to be key, and the charge will start at 2.5k per annum on top of usual council tax, and will rise to 7,500 at the top. Now, of course, this might be opening the door to greater charges in the future, or a reduction in that valuation limit. So some people might be considering this in terms of, particularly if they're asset rich and cash not quite so rich, they might be thinking about how they're going to manage that charge. They might be thinking about selling and downsizing properties. It's really important to take advice on that, because there are ultimately other tax charges that will fall in if a property sale takes place. Think about the overall position for the family in terms of how that tax charge is going to take effect. So those really are the highlights of the budget this time round. Before I pass on to Anisha, who's going to, together with me, talk us through the main budget changes that were announced this time last year to take effect from April 2025 to the international community in the UK. One good piece of news from this year's budget is mention of a global talent investor visa. I think that's definitely showing that we're moving in the right direction, perhaps a little too slowly for my liking, but definitely moving in the right direction. And the very little detail we have on it at the moment gives reference to a tax offer. So let's keep hopeful on that while we talk through what we do know about the current position for international people here in the UK. Thank you, Anisha.
Thank you, Helen. So Martin and Helen have highlighted the changes, as I've said, in the most recent budget. And what we really want to do is delve into the changes of the last budget that took place in October 2024, as this really had a huge impact on internationally mobile individuals who were living in the UK. We've moved away from the old domicile rules to a residency-based regime, and that shift really has impacted how UK individuals need to manage their tax affairs, their overseas assets, and their longer-term plans. So what we want to do today is really take you through what's changed, what it actually means in practice, and the key points you should be thinking about as they apply to you. So under the old system, everything really hinged on this idea of domicile. So essentially your long-term homeland and where your permanent base was. If you were living in the UK, so UK tax resident, and weren't UK domiciled, you could claim the remittance basis for your foreign income and gains for a certain period of time. And what that meant was that your foreign income and gains would not be liable to UK tax unless remitted to the UK. For UK inheritance tax purposes, your non-UK assets would sit outside the UK net until you became essentially deemed domicile, so UK tax resident for 15 out of the previous 20 tax years. It was a particularly generous regime, and it really did influence how people arranged their assets, their investments, and their broader wealth planning. So what do the new rules mean? Domicile is no longer the key factor. The concept of domicile has been completely abolished from 6th of April 2025. Your UK tax position will now be based on UK tax residency, which I'll go into in a moment. But really, that's a significant change. Many of the long-standing ways people used to plan their affairs may no longer work in the same way. And really, what's important is that whilst this transition can feel a bit tricky, the new rules actually do make things clearer and over time easier to navigate. Domicile used to be quite grey, whereas residency under the UK statutory residence test is a bit more black and white and making it easier to determine your overall UK tax position. So an individual's UK residence position is determined under the UK statutory residence test. There are various tests within the SRT under which a person can become UK tax resident, including day counts and ties. There are more complicated rules, and really, in light of the recent changes, it makes it more important than ever to seek residency advice before arriving to the UK or considering leaving the UK or restructuring your overall assets. Split year treatment is also available, so if you arrive in the UK partway through the tax year or leave the UK partway through the tax year, you can split the UK tax year into a period of non-residents and UK residents, and actually that can be a really effective tool at reducing your overall UK tax exposure. So moving on to the new rules that were announced in the budget to maybe encourage individuals to relocate to the UK. So under the new rules, if you've been non-UK tax resident for the prior 10 out of the 20 tax years, new arrivals will be eligible under the foreign income and gains regime. And what this regime does is exempt your foreign income and gains most for the first 4 tax years. So this gives newcomers a window of 4 years to have their foreign income and gains exempt from UK tax, but after the 4-year period, you will then be liable to UK tax on your worldwide income and gains, with the availability of foreign tax credit where appropriate. So effectively, this is a measure that looks to replace the remittance basis, but for a much shorter period of time. And it's important to note that whilst the foreign income and gains under this regime may be exempt, there's still a requirement to disclose on your UK tax return your foreign income and gains relevant for that period. It's not exactly clear yet how this will work in practice and how this will be reflected on your UK tax returns, but that's why it's absolutely key to seek advice and make sure your reporting requirements are up to date before you come to the UK. The second measure is the temporary repatriation facility. So this facility is available for individuals who previously claimed the remittance basis under the old non-dom rules. It lets individuals designate and remit foreign income and gains that arose before 6th of April 2025 that were previously protected by the remittance basis. So instead of paying tax at the usual and higher UK income tax and capital gains tax rates, the amounts designated will be taxed at a flat reduced rate, being 12% in 25-26 and 26-27, rising to 15% in 27-28. This facility is only available for 3 years, so it's really valuable for anyone planning to stay in the UK long term and think about the funds that you need in the UK so you can take full advantage of this facility. The final measure is the availability of CGT capital gains tax rebasing. So certain individuals, there are some nuances with this, but who have previously claimed the remittance basis can rebase their foreign assets held personally at their market value on 5th of April 2017. You have to have owned the assets prior to 5th of April 2017, though, to benefit from this. So that really covers the main changes for income and capital gains tax purposes. So moving on to UK inheritance tax. So under the old non-dom rules, the treatment of overseas assets for UK inheritance tax purposes was very favourable. If you were UK tax resident but non-domiciled, most of your foreign assets sat completely outside of the UK IHT net unless you became deemed domicile. This really allowed families to pass on overseas wealth with minimal tax exposure and hold overseas assets without worrying about UK inheritance tax. For many individuals, as we've seen with clients before, it really did form a core part of long-term estate planning. From 6th of April 2025, that's all changed. So if you've been UK tax resident for 10 out of the previous 20 tax years, you'll be considered a long-term resident. And as a long-term resident, you'll now fall within the UK inheritance tax regime on your worldwide estate at 40%. Even when you leave the UK, there's an IHT tail that can continue for up to 10 years, depending on how long you've been UK tax resident. So in other words, that long-standing protection for overseas assets is no longer there. This is a major shift, one that takes getting used to, particularly from anyone coming from countries like Australia, where inheritance tax doesn't exist at all, to now suddenly facing potential UK inheritance tax exposure on your worldwide wealth. So what this means in practice, this is where we're really advising clients to pause and take stock. The new rules raise several important planning the 10-year mark without realising. Many individuals drift in and out of UK residence. The SRT day count can catch many people unexpectedly. Do you hold significant overseas assets that were previously outside the scope? Overseas property, investments, family wealth structures, all now may be brought in the scope of UK inheritance tax. Are your current trust arrangements still fit for purpose? Some structures designed under the old rules may no longer give the same protection they once previously had. So if you're approaching that milestone or you've been moving in and out of the UK over the years, now is really the time to review your estate position and your overseas assets. Whilst the rules may not be as favourable as before, the framework is definitely clearer, and with proper planning, you can still manage exposure in a structured way. So I'll pass over to Helen to talk about overseas trusts.
Thanks, Anisha. So trusts are often used by those coming to the UK, and from our experience, they're really very common with Australians, because we have a very similar trust law position. Whether a non-UK asset in a trust sits outside the UK inheritance tax net depends now upon the status of the settler. So let's say you're in the UK, you've settled some assets either before you came to the UK or in your first few years of being in the UK, and you haven't been here for 10 years as yet. To the extent that that trust holds non-UK assets, those non-UK assets will not trigger a UK inheritance tax charge as they sit within that trust. Now, trusts under UK law are generally, and there are some nuances here, but are generally charged to UK tax every 10 years or as and when assets leave or join the trust. Once, under our new rules, once we get past the settler having been in the UK for 10 years, so they are now classed as a long-term resident, the status of the trust will shift. So the assets that sit within the trust once the settler is long-term resident will fall within the UK tax net. And at the next point that trust gets to a 10-year anniversary since its creation, or an asset leaves the trust, then that asset base will be charged to tax. And the maximum charge at that point in time is 6%. What needs to be thought through is whether there's anything that can be done to the trust to stop that taking effect. Some people, of course, have got a huge amount of wealth sitting within a trust, and they might have actually reconsidered their UK tax position and residency position in its entirety. And there might be situations where actually that trust isn't quite fit for purpose anymore, so perhaps they're thinking of winding up that trust and staying in the UK. So we've put on the slide excluded or relevant property, and what that means is that historically non-UK assets within a trust settled by a former non-dom has always been classed as what we call an excluded property trust, i.e. the assets are excluded from the UK IHT net. That is only going to take effect now for non-UK assets where a settler is not yet long-term resident. Relevant property is the other flip of the same position, but that's the assets that are subject to UK tax. If an individual with a trust decides to leave the UK at some point after they have become long-term resident, then there is a mechanism in the new legislation to give a migration charge. So it is an exit tax. It's not on everything that's owned by that individual. It's just the assets within that trust. So those trust assets will be charged to tax again at a maximum of 6%. There are also income tax and capital gains tax things to think about as regards trusts. And those income and gains will either be straightforwardly taxed on a look-through basis on the settler while they're UK resident, or because we might have a position where the settler is in Australia, but there's a beneficiary in the UK, there are mechanisms to tax the income and gains in that trust, sometimes on a deferral basis. So they don't take effect when the actual income and gains are generated, but instead are charged when the individual receives benefit in the UK. That might be a distribution from the trust. It might be an interest-free loan from the trust. So there are lots of things to think about as regards Australians coming to the UK who have a trust in place. And I guess the overriding message is take advice. Thank you. Back to you, Anisha.
Thanks, Helen. So what I want to do now is just summarise what the key things you need to think about if you're looking to arrive or leave the UK. So starting with arrivers, plan your residency in advance. Getting advice before you arrive is absolutely crucial as residency now drives your UK tax position. Think about split year treatment. If you arrive partway through the tax year, this can reduce your exposure. Check your eligibility for the 4-year foreign income and gains regime because this can provide a 4-year exemption for your foreign income and gains. Temporary repatriation facility. If you've been UK tax resident before and you've claimed the remittance basis, then this provides a really valuable 3-year window to bring funds over to the UK at a significantly reduced rate. And generally review your long-term plans carefully, particularly regarding UK inheritance tax and how your overseas assets may be impacted. If you're considering leaving the UK, manage your residency carefully, avoid unintentionally creating extra UK residence tax years, use split year treatment where appropriate, understand your UK inheritance tax tail, so your UK inheritance tax exposure may continue even after you leave. Review your UK situs assets because they'll still continue to be subject to UK inheritance tax. And be careful of the temporary non-residence rules, which are an anti-avoidance measure. So if you leave the UK and generate foreign income and gains during that period and become UK tax resident within 5 years, those foreign income and gains in that period will fall taxable when you arrive back to the UK. I think that's the end.
Super, thank you, Anisha. So I can see we've got a couple of questions in the chat. One is, can a deemed tax resident who's lived in the UK for more than 15 years reassess their value of their Australian assets based upon the 2017 valuation? Yes, in general terms, they can. There's a rebasing opportunity. There are some nuances to it, as Anisha mentioned, but talk to us and we can help work out your optimal position. See if there's any other questions there. So when does this begin? Carolyn, the new rules came into effect from April 2025. So we actually are now sitting in the tax year which is the first year under the FIG regime. The reporting for that doesn't take place until after the tax year has finished, and the self-assessment deadline for that year is 31 January 2027. So that's why it's still quite a live situation. Sure, Martin, if you can see any other questions there.
Helen, I'm just wondering, we had a number of questions come in advance of the webinar. I'm wondering if we could maybe pick out a few of those that you feel maybe important, or should I say relevant?
Yeah, I'm going to bring a few of them up now, Richard.
Perfect. Thanks,
It's
Martin.
my computer seems to not be playing ball, but I'll go there in a
While you're
second.
doing that, Martin, shall I answer one question that's in the Q&A about
Yeah,
Yeah.
when does IHT kick in, as in the sterling threshold? So IHT generally comes in once you have £1 million worth of value. So the reason we talk about it at the £1 million mark is that each person has a £325,000 nil rate band on which zero IHT is charged. They also have a £175,000 threshold, so collectively 500, which applies to their main residence, where that main residence is passed down on death to a direct descendant, so their kids or their grandkids. You can then transfer your allowances effectively to your spouse. So when the first spouse to pass away goes, there is no IHT generally, to the extent that assets go to the spouse, the survivor, and those allowances transfer with them because they're not needed at that point in time. And then when the surviving spouse passes away in the future, they benefit from the £1 million allowance from collectively.
fantastic. There's a few questions here that I've got. One of them, if you are Australian born with UK dual citizenship, living in the UK and earning your primary income in the UK, do you need to advise your UK bank that you're a tax resident in Australia, even if your only financial interests there concern the income from renting out your former Australian home? I think there's a couple of points there, and the wording is key here. And the fundamental understanding of tax residency is key, because tax residency is typically done on the amount of days you are spending in a jurisdiction over the course of a tax year. And if you are living in the UK and earning your primary income here, you are typically going to be a UK tax resident, not an Australian tax resident, even though you have Australian income from home. But a question to Anish and Helen is that if you are living in the UK, and you are a UK tax resident, but you do have overseas income in Australia, is that going to be reportable on a UK tax return, even if you are an employed individual in the UK?
In short, yes.
Oh,
So for the first 4 years, if you qualify under the FIG regime, i.e. you weren't a former non-dom who's been here for many years, you're a new arriver, the first 4 years, you won't be taxed on your Australian income, but it does need to be reported to HMRC. So the two things aren't quite the same. After those first 4 years, your Australian income will be taxable in the UK, but credit will be given for the tax suffered in Australia. So tax credits are really going to help us out here and do the heavy lifting in making sure that individuals do not suffer tax in two jurisdictions. Hopefully that
so
answers the question.
yes, I've got a question on the Q&A from Carolyn. How can we find out how long our tax tail might be? I'm a dual citizen, resident UK 20 years. I hope to retire in Australia in 5 years from now.
So the tail is probably one of the most complex bits of the new legislation. The maximum it will be is 10 years. And that sounds like an awfully long time. But actually, under the old regime of domicile, the position was really grey. And it was really, really difficult to prove that somebody intended to go back to their home country at any point in time, if at that point in time, based on the facts, they were still here. So we do have more certainty, but it's a maximum of 10 years and it's a minimum of 3 years. And it just depends on a individual basis how many years you've been here in the meantime.
Fantastic. There's another question here. Is there an easy way to identify the FIG regime exemption via the self-assessment tax return? It does not appear as a direct or obvious option.
It won't be available obviously until you complete your 25-26 tax return, but I suspect there will be a section added, obviously, to the residency pages of the tax return to then claim the regime for the 4 years.
And we sound a little vague because we don't have it yet.
Yeah.
Another question here. Previously, if you were an Australian tax non-resident, your Australian interest income wouldn't be taxable in the UK. With the new rules, is this Australian interest income fully taxable in the UK at marginal tax rate, but reduced by the amount withheld?
So the gross amount will fall onto your UK return. So really it's an extension of our question before. So once you're past your 4 years, you are taxable in the UK on your worldwide income on the gross amount, with then credit given for Australian tax suffered.
It's fine. There's another question here. What are the typical pricing brackets for tax advice from Menzies on this? Well, if you want to reach out to us, you'll have all our contact details. We can understand your situation in as much detail as we need to be able to provide you a quote for the work. I think every individual person's circumstance will be different, and therefore pricing for such advice will differ considerably depending on how complex your position is. Going back to the questions pre-webinar, bit of a long one. If I spent 7 months in the UK and 5 months in Australia with residencies and ties in both countries, but most of my income is in Australian dollars, which country is considered my tax residence under the UK-Australia Treaty? I obviously would prefer to be an Australian resident for tax purposes to get the tax-free threshold. Also, how should I correctly coordinate my UK self-assessment with my Australian return to avoid double taxation?
Okay, so what we're talking about there is an individual who is both resident in the UK and resident in Australia, which is quite common. So if those two residencies positions stretch across the whole of the year, you are dual resident. So from a UK perspective first, we would file a return to say that you're resident in the UK, but we would then fill in some additional reporting which goes through the questions that sit on the double tax treaty that exists between the UK and Australia. So what that does is it looks through things like, do you have a permanent home in each place? Do you have particular economic interests in each jurisdiction? And ultimately, it looks for your centre of vital interest. So where your ties are closer to, and that can shift over the period of your residency here in the UK. You might begin as dual resident with closer ties to Australia, and then over time that can shift to the UK. So the treaty position really does need to be looked at year upon year on a bespoke basis with your particular situation in mind. Once that dual position has been decided, we then use the treaty to go through every single source of income and gains to work out which jurisdiction under the treaty has the primary taxing right. Some treaty clauses will say that income can be taxed in both jurisdictions. Other pieces and clauses say that something can only be taxed in one jurisdiction. So we run through that, we work out how the tax credits work, and then work out your overall position. Now, the UK and Australian tax years do not align. Obviously, you have in Australia a 30 June year end, and we have a random 5th April year end. So we make sure that we work out how income lies across those two tax years. And occasionally we actually treat them on what we call a coterminous basis, which is where we say to UK HMRC, we are going to treat this income for the Australian tax year as if it lies in the UK tax year, and we don't apportion it. That again depends upon the income and depends upon the individual circumstances.
Thank you. Very in-depth answer, Helen. And I think it just highlights the complexity. And again, going back to my previous point, every individual circumstance is different. I'm glad we left enough time at the end for questions because they're flying in now.
If we don't
Linda
get to
asked,
them all, we will follow up with you separately afterwards.
absolutely. Linda asks, I am a dual citizen living in the UK 18 years. I don't have assets in Australia, but can assume I will inherit my parents' estate eventually. Her question is, what will what will the UK tax implications be if I inherit while living in the UK as a UK tax resident? Or two, what would the UK tax implications be on this, given that she's been here 18 years, if I move back to Australia, say in the next 6 to 12 months?
Okay, let me try and break that down into what I think are the key points. If you inherit an asset while you're in the UK, then the inheritance of that asset doesn't give rise to a tax charge in itself. What it does mean is that you now own an asset that may be income producing, and that income will fall into tax in the UK as you move forward. The other point to think about is that your estate now, from a UK perspective, has grown. And so hopefully many years down the line, when it's your turn to either gift assets or pass away, that estate is much bigger. And if at that point you are UK long-term tax resident, then there will be a UK inheritance tax charge based on the size of that worldwide estate. At the same time, you've got Australian capital gains tax to think about, because Australian capital gains tax kicks in with inherited assets, which is not something that we have in the UK.
Thank you very much, Helen. We've got a few more to come. Is a superannuation withdrawal from the age of 60 subject to UK tax?
That I'd have to look up. I don't know the answer off the top of my head. Australian super is quite a different concept to what we have in the UK, so it needs to be looked at as to see what you're drawing down and what's occurring.
Thank you. Jessica asks, is there any impacts on HEC's fees? Not quite sure what
Again, yeah, I'm not
HEC's fees
certain, I'm
are,
afraid.
but we can come back on. We can look into that and come back to you.
Yeah, Martin,
Yeah, go
the
on.
HEX is it's an education charge.
Right.
I dare say one of our young professionals has probably submitted that question, or possibly a more mature adult. But it's a higher education charge.
Really
There's one
happy to
above.
look at that. Yeah, go on,
Yeah,
Rich.
there's one above that.
Yeah, this
Martin.
is SR.
Yeah. Yes. That. Yeah.
I'll
Sorry.
ask that, Richard. I'll ask that.
How does CGT work if you sell an Australian property? That particular one from SR.
Yeah.
Yeah. Do you want to? Can you take that one, because I think that's a really interesting one.
Yeah. So, how does CGT work if you sell an Australian property, but A, live in the UK, B, move back to Australia, or C, move back to Australia and you have lived there as a tax resident for more than 10 years? So,
Okay.
the IHT tale is no longer relevant. Assume no
Okay.
trust involved and own. Yeah.
Yeah. Okay. So, if you're here in the UK and you're past your first 4 years, then if you sell an asset in Australia, then the capital gains tax position in the UK needs looking at, because you're charged to tax on your worldwide assets. Now, the only thing that could counter that is the treaty. If the treaty said that you were only that is only taxable in Australia, unlikely. So there's a dual position, and you take credit in the UK for the Australian tax paid on that disposal. So that's step one. If you make that disposal instead, once you have moved back to Australia and you are no longer tax resident in the UK in that tax year, then that disposal will not be considered from a UK tax perspective. So the LTR tail only applies to inheritance tax. It doesn't apply to annual taxes like income tax and CGT.
Thank you very much, Helen. Carolyn's asked a question which applies to everyone. How can I book an appointment for personalised tax planning advice? Well, an email will be sent by Vera and the team afterwards, which will include Helen, Anisha's and my contact details. Please direct any questions to Helen and Anisha, not myself. I'm more corporate and business. And they will be able to book in a non-obligation conversation with you, for which we can understand your situation and provide you a quote for assisting, and then we'll be able to then move forward if you agree the position. And a final question here is, part of Linda's question wasn't quite answered. It says, what if she inherited cash from her parents' estate? What is the threshold in the UK, I assume, for inheriting from overseas estates?
So the only thresholds that need to be thought about are whether you go over that £1 million mark that we talked about earlier. So that's from an inheritance tax perspective. If we're talking about the annual income tax position, then that savings income that is generated on that cash moving forward will fall into the normal threshold bands in the UK for UK tax.
Perfect.
I can go through those thresholds if it helps.
I think, I mean, we're running short of time now, and I think plenty discussed, and you can tell it's a hot topic. Lots of questions coming through there, lots of questions asked, and we can reply to them afterwards. And if you've got any further questions, then again, our contact details will be provided in the post webinar email. And Richard, I'm going to pass back to you now for some final thoughts.
Thanks, Martin. Yeah, look, this is a really, challenging area, and there's no question about it. If ever there's a time to seek professional advice and guidance, this is the time. Honestly, there's a lot in play here for a lot of international people, and this is the time to step forward. And I think, really getting some absolute clarity about definition of residency as it applies to you, and Helen, correct me if I'm wrong here, is one of the key cornerstones of this process. And then establishing, what does that mean in terms of how many years I've been here? That 4 and 10 year mark are pretty important tripwires for a lot of people. So some interesting things to think about. Definitely get the advice. Don't leave it too late. That's the best advice I can provide. I want to thank the speakers and for everyone staying with us throughout this webinar. As I said, it's been recorded. For those people, and I've spotted a few other questions that have come through, thank you. I do know the Menzies team will follow up, but they're looking forward to sort of chatting with you about some of those questions, giving you a response. So you will hear from them. And again, thank you to Helen, Anish and Martin for your time and expert advice. It is a fascinating conversation for all the wrong reasons, but it is a really important one for all of us. So again, thank you to our speakers and thank you to everyone for joining us. Richard Basil-Jones signing off from the Chamber. Thank you again.
Thank you, everybody. Thanks for the opportunity, Richard.